Hey, welcome. It's Charlie with Cameron Capital Partners. In this video, I'm going to go through an introduction to real estate investing. Now, this is quite an in-depth, perhaps, video. It's going to be about a half hour long. I'm going to talk about four strategies that people usually use when they talk about real estate investing, some techniques, the categories you can kind of separate investing into, and then I'm going to go into deep dives on numbers on four specific deals. And then I'm going to talk about multifamily, why I love it. I'm going to talk about syndication, what that is. We're going to talk about the impact of COVID, and that's about it. So we're gonna jump into this thing. I actually recorded this webinar the other night. It went really well. Had a bunch of people there, a lot of good questions asked. However, I stupidly selected the wrong sound, so it has no sound. So this is basically re-recording, and I updated some slides and kind of revisited the order to make it a little bit better. So let's just, without further ado, jump right into it here. If I can get it to move. Okay, so in typical military fashion, I'm going to tell you what I'm going to talk about. So, what is real estate investing? We're going to talk about reasons to invest, categories and strategies. We're going to walk through four specific deal examples. I'm going to talk about multifamily benefits, what syndication is, what my mission is, and then what COVID means for the market. So what is it? To simplify this down, it's one of two things. Real estate investing is either buying and selling real property to create steady long-term income, or doing the same thing to solve a problem for others and then cash out. And you can combine those two things. So we'll look at those two categories and what strategies fall beneath them in a few more slides. But that's the simplest way to look at it. But before we go into those, let's talk about four profit centers of real estate. This article, the link below, is what turned me on to real estate. A buddy of mine and I were at a bar, and he's like, "What about real estate?" And I was like, "That's stupid, right? The typical first, idiot doesn't know anything about real estate investing answer, right? The unknowing answer. I don't want to fix toilets, right? The returns can be much better than the stock market, and so these are kind of four of the big reasons why. You got cash flow. So after you pay all your expenses and your principal and interest payments, you can make money every month. You can net cash every month. You can use that to replace some of your income if you'd like, or all of it if you do really well, or you're really dedicated. And then amortization, that's where you're letting your tenants pay down the principal, paying the mortgage and paying the principal down. You're building equity over time by owning this property, and somebody else is paying for that equity. And that comes on top of cash flow. So you can look at your cash on cash return. You want that to be pretty decent, but you should also factor in the long run, how much you're netting by paying the principal down as well. Okay, depreciation. And then you have depreciation. The government lets you write off the purchase of a property, the building itself, over 27 and a half years or sooner if you apply kind of an interesting cost segregation tax study. Now, why does the government do this? Well, they're incentivizing property owners because the government doesn't own most property, and they don't own most rental property, and they don't house most Americans. So private owners go out and do that. And the reason they incentivize private owners is because the government can't afford and is not in the business of doing it. So the way they do it is by incentivizing us, lay people, to go out and buy property and be landlords for the general public. And this works really well because it allows housing for most Americans, creates a ton of jobs, property management, contractors, agents, you name it. Tons and tons and tons of jobs are created by real estate investors. And then appreciation. So I never count on appreciation on my properties. What I do instead is I call that my hedge against inflation. So if you buy an index fund with a stock market that's supposed to make 10% a year over the long run, you got to subtract a couple percent for inflation. With property in the long run, real estate appreciates 2 to 3% a year. Just like inflation kind of depreciates the value of your money by 2 to 3% a year in the long run. Now, they don't track exactly the same, but in the long run, they're about the same amount per year on average. So to me, I count appreciation as my hedge against inflation, right? It's pretty cool. And something else you can do, which I do look for, is forcing appreciation, which we'll get to. Now, more reasons to invest. So potentially higher than stock market returns. I would not be investing in real estate if I didn't make more than passive income or passive mutual funds, index funds. Um, Fantastic tax benefits, right? If you do things correctly, then you can have actual gains but book losses, like for that depreciation of the property. And then you have ways to actively or passively invest. You can go out and do it yourself. You can pay others to do it. You can fund others. Um, you can force appreciation, which I'll get into later. It's kind of this phantom equity you can build. There's tax techniques to accelerate depreciation, pay less taxes initially on the property. There's tax deferred exchanges. So you can buy a bigger property later and defer the capital gains on that first one to when you sell the next one. You can keep doing that and stepping up. There's other tax write-offs. All your expenses you can write off, and then it's a tangible asset you can go up and touch, unlike a stock, and you have control over it, unlike a stock. And like I said, it's a hedge against inflation. So, two broad categories that I consider real estate to be. You've got long-term buy and hold, and you've got problem solving for cash. There's also kind of a third category, and that's providing financing in return for an interest rate return, or buying financing, buying loans or notes as they're called in real estate. Um, so those are some other common passive income streams in real estate. But the two that people are really familiar with are on the left, the long-term buy and holds, the single families, the apartments, the commercial real estate. And on the right, the flipping, the wholesaling, the development. And the way I kind of look at this is the stuff on the left, they're great for generating monthly cash flow. The stuff on the right is great for netting equity to invest somewhere else or to use somewhere else, like the stuff on the left. So the stuff on the right, make no mistake, those are more like jobs. And the stuff on the left are more like investments. Now, you can definitely combine these two things. For example, burring, buy, rehab, rent, refinance, repeat is when you buy a property, you flip it, you then rent it out, you refinance your money out of it, and then you go do it again. So now you've got that long-term rental at the end of it, but you did that flip, that kind of hard work as well to get there. So there's ways to combine these two strategies for sure. Okay, so these are the four that we're going to walk through for number examples. Let's jump right into it. Let's keep these things in mind though as we go through these. What works in one market may not work in yours, or vice versa. So it depends on the area, it depends on what the market conditions are in that area right now, the overall market conditions, all those kinds of things. There is always a way to make money in real estate in every market. Don't ask me how people make money in LA, but people are doing it. And you can connect with those people pretty easily. And prices and rents, obviously, those vary greatly by market, by property type, by condition, by submarket, location. So the examples I'm going to show you are just examples that I've seen from markets I'm familiar with. But you know, your mileage may vary. Okay, liquid fuel, here we go. Single family rentals. This usually happens by accident. Somebody buys a house, they move, maybe they couldn't sell it, or maybe they said, well, maybe I'll try renting it. Maybe we'll be back here, right? Military especially, maybe we'll be back. So they rent it out. And then all of a sudden, hey, look, I'm like making money on this thing. This is great. Maybe I should consider doing more of this. Right? That's kind of generally how people get into real estate investing. Either that or reading Rich Dad Poor Dad. Those are the two ways people get into real estate investing. That's just how it is. What you want to do though with single family rentals, if you buy a house that you're going to live in that you then intend to rent out later, is do the math and make sure it would make a cash flowing rental. That's after you pay all the expenses, the principal and interest, right, the mortgage, and the capital expenditures and property management. Those are the ones that people fail to account for. Now you can easily manage a single family home yourself from out of state. Totally doable. So you don't have to factor that in. I like to factor those things in because property management is just a job. And I'm looking for more passive income than that, not really more jobs. And don't forget about capital expenditures, like I mentioned. AC units, driveways, roofs, those big things will come due if you own this property for 20, 30 years. So you've got to keep those in mind. And what I do is I account for it on a monthly basis and I just save that money. And I think that's how you should do it as well. So make sure you have some reserves when you buy it and make sure you're accounting for those larger expenses in the long run. So here's a real single family example here in Fort Walton Beach, Florida. Let's say you buy a 2-bed, 2-bath townhome for $105,000. You put 20% down, Lenders are usually doing 20 to 25 on deals like this using a conventional loan on a rental property. You borrow 84,000 then at 4.25%, today's rate, over 30 years. Let's say the renter pays all utilities, which is pretty common on a single family home. On the right, you've got kind of the breakdown of income and expenses. 1,100 is on the low end for this type of property in this area. I always am conservative with my numbers, so I overestimate my expenses and I underestimate my rent, and then I'm happier when things turn out better. So you can see here, here's your mortgage, here's your taxes, here's your insurance. Insurance is kind of low because it's a small unit and your HOA fees pay for some of the external stuff. You got your HOA, you got estimated repairs and capital expenditures. I threw in 10% of the rent amount. And then vacancy, I threw 8% in. I understand that's not an expense you will pay every month, but vacancies happen, right? So what I'm accounting for is, 1 month out of the year, or a few months out of every couple of years, you might be vacant. All right, so that's kind of accounting for that on a monthly basis. So your cash flow here looks to be about $255 or so. So you put $21,000 down. Let's take that $255, multiply it by 12 months. That's $3,000 a year in annual cash flow. Divided by the amount you put down, that's a 14.6% cash on cash return. That's decent, right? That's a decent return on your money. Now, if you look at how much you're going to pay down over 30 years, it comes out to an average of $2,800 a year in principal, in equity, right? That whole property will be paid off, and I'm assuming no appreciation. So that whole property will be paid off in 30 years. So that $2,800, if you add that in as the actual return you're getting in the long term, you're looking at a 27.9% total return on this property in the long run. Tell me how you get that with a simple index fund in the stock market. I don't know, but that's awesome. Now, I said I like to factor in property management, so let's throw that in here. So let's assume 10%, which is pretty common on a single family rental. You're now looking at only $145 a month. Now, I shouldn't say only, because a lot of investors are looking for $100 to $200 a door on their rental properties. So it's actually pretty decent. It falls right in the middle of that ballpark. Now, if you look at that, it's only an 8.3% return, which is okay, but the actual return on it is still 22% in the long run because of the equity paydown. So it's still a pretty good deal if you look at the long term as opposed to the monthly cash flow. I understand a lot of people looking for monthly cash flow return, which is fair. So you can look at managing this yourself. You can look for more returns. You can look for ways to decrease your expenses. You can look for ways to push up your rents by improving the property. So lots of ways you can increase that bottom line for that rental. Okay, hold on one sec. Okay, short-term rentals. You know what this is, Airbnb, right? Beach condos, cabins in the woods, vacation destinations, Orlando, wherever. They're taxed a little bit differently. They're generally higher income use. So you generally make more money off of them. We'll talk about that in a second. Some expenses are passed on to the renter, right? You're thinking, oh, if I own an Airbnb, I got to pay for cleaning, I got to have the fees for the... Well, actually, the cleaning is usually rolled into the costs that the tenants or the occupants are going to pay. And as far as management goes, you can also self-manage Airbnbs. You just have to know who your cleaner is going to be. You have to have turnover procedures, that kind of thing. You have to be willing to talk to the potential tenants before they come to the property, provide them information. So there are ways to avoid paying the property management on short-term rentals, which is a lot more than single-family rentals. It's usually around, in my market, 18%. So if you can buy a property and manage it yourself, holy smokes, that's 18% more you're going to make each month. That is a huge margin there, but there's still ways to cash flow on short-term rentals, even with management in place. The key with short-term rentals is heads and beds. You got a one-bedroom condo, you're going to get 2 people in there, maybe 4 if you have a pull-out couch. You're limited. If you've got a 5-bedroom house with some extra space for a couple pull-out couches, now you can house a lot more people. Multiple families can come in. Your rental income is going to skyrocket, and usually a 5-bedroom house doesn't cost 5 times as much as a single-bedroom condo in that same market. So something to consider there. So risk versus reward. Long-term rentals, lower risk, more stable, right? Especially if it's a primary residence. But short-term rentals generally have a higher return. However, there's more risk. As we see that now during this kind of COVID time, some short-term rentals are closed or banned. Um, my personal thoughts is that's not going to last, and we'll talk about that at the end. Short-term rentals. Here's a real example from my market. So a $600,000 house, it's been on the market a while, so you can probably get a better deal. 5 bedrooms. So we're going to assume an estimated return of about $70,000. Maybe with an extra pull-out couch, some more curb appeal, you could push it up to $90,000. Better management perhaps as well. But we're just going to go with $70,000. That's based on the 5 bedrooms. So we estimate our expenses at $25,000. These numbers come from our own real estate agent team here that does these kind of analyses for investors. So we've got a whole spreadsheet of all the short-term rentals in this area, and we are able to pull these numbers immediately and know which properties are likely to cash flow and which are not. So there's some expenses. Our estimated monthly principal and interest on that property is about $2,500 or $30,000 a year. I'm assuming a 10% down. I'm assuming a lot of investors on their first vacation rental, they use a second home loan, which allows you to put 10% down, which means your ROI is going to be higher because the money you're putting into it is lower. So looking at this, net operating income is at $70,000 minus the $25,000 in expenses, about $45,000. And then we remove our principal and interest, the $30,000 there, to come down to about a $14,000 cash flow. Now, if we take the $60,000 we had to put down, right, 10%, and let's throw in 5% reserves, because we should have reserves to handle things like COVID, roof repair, whatever. So let's throw that in the amount that we're going to look at. So now we're looking at $14,000 over $90,000 comes out to about 16% return. And I didn't count reserves for that single family house. So I'm counting it here. I think higher risk means more reserves. So I think you should look at that when you do short-term rentals, but that's still a great deal, 15%. Now look at this. Your total return on investment, because you're paying down $20,000 a year in equity, is 38% total return. Blah, right? Wow. That's crazy. Yes, it's kind of a weird time for short-term rentals in the middle of COVID. They will be back. They will be back. I have the feeling that there will be deals to be had here pretty soon in this market. So flipping, right? This is what everybody thinks of with real estate investing. This is not investing. This is a job, okay? You can use it to help you in investing. You may use flipping and rehabbing and renovations in any deal, in any real estate investment deal or rental property deal. But the act of flipping houses on a short term is not investing, it's a job, okay? You've seen it on TV. What you don't see on TV is that those teams and the big flipping teams out there, they're buying in bulk. They're getting 30-40% discounts at Home Depot. They're hiring their own massive teams. They are flipping fast within 4 to 6 weeks on each property. They're licensed, so they're getting the commission on both sides of the sale. You know, they're doing all this stuff. They're doing off-market marketing as well, so they're grabbing properties before they even come to market, which are even better deals, right? So they've got these huge systems in place to have much better margins than what I could do on my own or what you could do on your own, right? However, it does work. You can go out and flip a property and make a profit, which we'll look at in the next slide. Why does it work? Well, because people are willing to pay more for something than it actually costs. Why is this the case? Because a family walks into a house and goes, oh my goodness, no, I can't do this green paint. Let me go buy this $30,000 more expensive more expensive property instead. You're like, what? That was like $100 worth of paint, you know? So this is real. This is what people do. They can't see past the renovations themselves, so they buy something else. That's why flipping works. What you want to keep in mind with flips, especially if you're going to go out and try one on your own, and that's maybe your first investment, have good reserves, because you got to be mindful of these hidden issues. There are always hidden issues. Normally they're minor. Sometimes they're major. Foundation, mold, structural issues. These big flippers that are flipping hundreds of properties a year, thousands of properties a year, they can handle hiccups here and there. If this is your first one and you happen to get the bad one, that may be it for you for a long time, right? So just keep that in mind. Here's an example. This is one I made up. I didn't pull a real example, but it is similar to things you can find. So let's say you find a property for 110,000. Hold on. Or that's an MLS deal. It's an off-market deal, a wholesale deal, a foreclosure, a bank owned, direct mail, whatever it is. You determine the after repair value, which to me is the hardest part, to be 225,000. Estimate expenses. Your contractor says it's going to be 40,000 to flip the property with everything you want to do to it. Let's say it's $3,000 just to close on it. It's going to be $3,000 to hold it for 6 months. It's going to be $4,000 of financing up front and monthly for 6 months, and $16,000 to sell the property on the tail end. So if you were an agent, you'd save on some of those costs, maybe 20,000, but you're not, right? So total net proceeds, 225,000, less the 66,000 in expenses, less the price you paid for the property, comes out to about $49,000. If it took you 6 months to do, that's $50K every 6 months. That's a decent bonus, right? Keep in mind, this was work. Unless you're going to go hire a manager as well, which we'll cut into that. This is work. And then you got to consider the taxes. Unfortunately, because you didn't hold this for more than a year as a rental property, it is taxed at your normal income rate. Plus, you've got to pay all of the entitlement taxes. So you actually end up with about 2/3 of what you netted on that property. So kind of knock that down to 32,000, and that's what you're kind of looking at for this deal. That's a flip example. They're kind of 70% ARV. There's rules you can use in there to kind of help you figure out what a good deal is for a flip. I'm not a flipper. I have flipped small apartments. I've improved apartments. I don't really consider myself a flipper because I'm not trying to. I am doing this on a apartment scale and kind of smaller rehab or smaller renovations, but I don't flip single family houses, which is what you consider for flips, what most people consider for flips. All right, my favorite part. We're going to talk about apartments, or what investors call multifamily. What we're talking about here is more units per building, as small as a duplex to as many as hundreds or thousands of units in a complex. We're talking economy of scale here. So you look at this building, you see one roof, you see fewer walls, you see higher occupancy per land area. That means a lower tax burden per unit. You're looking at lower property management costs per unit. Instead of 10% on that single family house or 18% on that short-term rental, you might be looking at 4 to 8% on these. You're looking at bulk maintenance, bulk services, so you can get discounts there. You can use a dumpster instead of individual expensive trash cans, all sorts of stuff. And unlike single family, when one unit goes vacant, you're not on the hook for all of the expenses and the mortgage and everything. In this case, a few units can be empty typically, and you're still making money every month. So that's kind of a cool thing about multifamily. There's a lot of cool things about multifamily. I'm still going to go into a few more. So let's go through an example first. This is a real example. It's overpriced, so I put the price I'd pay for it. So $1.6 million for 48 units. They're rented at an average of $450 a door, but market is $550. So we'll get to why that matters here in a minute. So gross income, $21,000 a month. Our expenses come out to about 50%, which is about right for multifamily. So if you see something less than that, they could be lying to you. If you see something more than that, there might be opportunity there to fix it. But let's just say it's 50% in this case. So our expenses come out to about $10,000 a month. Our net operating income then is the $21,000 minus the $10,000, or $11,000 a month, or $132,000 per year. Now, net operating income doesn't include our debt service, or principal and interest, or mortgage, whatever you want to call it. So that's going to be about $5,700 a month. Now, so now we have our cash flow. We take that $11,000 a month, subtract that $5,700. We come out to about $5,000 a month in cash flow. Now, our cash on cash return comes out to that $5,000 a month cash flow, which is $60,000 a year. Divide that by $352,000, what we had to put down, 25% of that $1.6 million, comes out to, sorry, that's 20% of that $1.6 million, comes out to 17%. Um, awesome return, awesome, awesome, awesome. And then when we look at how much the loan is paid down in just the first 5 years, on average, we're looking at a 24% return. The reason I didn't do 30 on this is because for multifamily, I don't expect to hold it for 30 years. I expect to trade it up before then. So I usually just look at the first five years, which is the lowest amount of equity you're paying down per year, when I factor in actual return. So 24% actual return, awesome, right? And these numbers don't even include the tax benefits or forced depreciation. Typically, multifamily investors talk about the tax benefits being 3 to 5% additional return. It's really hard to quantify, but because you're paying much lower taxes on the income, that's kind of what they consider the tax benefits to be, though I never factor that in numbers wise. Let's talk about forced depreciation now. So investors call this repositioning. So let's say we buy this property at the market cap rate of 8%. Now, market cap is just a way to estimate that type of property in that market, in that condition, what investors will pay for it. So if properties like the one we just showed, this guy, in that market, in that condition, let's say they command an 8% cap rate. That means that if we take the net operating income, $132,000, divide that by the cap rate, we come up with the price an investor will pay for that property, right? 1.65 million. We paid 1.6. Okay, we got a little bit of a discount. Woohoo! But remember, we talked about the rents being $100 too low per door compared to market. That could be for multiple reasons. It could be crappy management. It could be that the units need updates. It could be poor marketing. It could be a lot of things. Certain services not provided, like laundry, something like that. So let's just say it's bad management. You're going to come in and fix that. It was a mom and pop, and now you're putting a professional manager in there. So that's $100. That didn't cost you anything. That's $100 times 48. That's $4,800 in gross income increase per month. Now, generally there will be some additional expenses as well, especially if you're like updating the property. Maybe there's nicer stuff in there, and now your maintenance is a little higher. It's generally not 50% of that, though, going back to expenses. But to be very safe and conservative, for this example, we'll just use 50% of that additional income actually goes back to expenses. So we'll just say that half of that we get to actually pocket as cash flow. We'll also assume there's no vacancy that we can then reduce, right? Increase our occupancy, which also increases our net operating income. For this example, we'll just leave that out, though there generally is a play like that as well on these properties. So now our cash flow is about $7,450 a month, or $90,000 a year, right? We were at $60,000 a year. We're now at $90,000 a year. So now our annual cash-on-cash return is 25%. And then looking at the first 5 years of principal being paid down, it's 33% actual return. That's amazing. And here's the even cooler part we haven't even gotten to. Now the value of our property is higher. Now, generally, if you fix a property up like this, the cap rate goes down, which is good for you, right? It might go down to 6%. Now the property value is even higher. But let's just assume that we didn't even increase the cap rate. We made no improvements really to the property itself. We just increased occupancy, or we improved management. We just raised the rents to market like they should have been the whole time. In that case, and it's still an 8 cap property, it didn't actually get any better, then we're still looking at now selling the property at 1.98 million. So now we've increased the equity in the deal by over 300,000, which is about the amount we put into the deal. A little bit less, actually. That's a typo on the slide. But that means if you were to sell this property now, you put 300 and some thousand into it, you're going to walk away with 600 and some thousand, right? You've doubled your equity. So not only did you get 100% return on the equity you put into the deal, but you also netted the cash flow each month, plus the equity you paid down on the loan over however long you held it. So 33% return, right, over the first few years. So there's a crazy amount of return you can get on these properties if you are able to reposition them along the way, even if you had to make some improvements to the units, which is typically true. Even if you had to put $3,500 into each unit by doing some painting, some flooring, some hardware upgrades, paint some cabinets, whatever. We're looking at a bulk scale here. you're going to get 100% return on that cost in this case by the additional equity. So it's worth doing. Multifamily, in my opinion, quite simply rocks. You got those economies of scale like we talked about. You got better financing terms. There's this weird space between more than 4 units and less than $1 million loan size where there's no good financing. You can get financing, but it kind of sucks. There's 20-year amortization, 20-year terms, short terms, resetting, adjusting interest rates, higher interest rates. They're holding your personal assets at risk. It's just crappy. But once you get above $1 million loan size, you get much better loan terms, Fannie Mae backed loans, which is way better. And then you can force appreciation like we talked about, build that phantom equity on a massive per unit scale. Cost segregation means you can take one of these properties, you can write off most of the taxes in the first few years, the value of the property in the first few years, which is huge. And then there's always, well, not always, but there's a general shortage of affordable housing right now. This is due to stoppage of building after the housing market collapsed in 2008. You're seeing a lot of new build now, but everyone needs a place to live, right? It's a low risk asset if you're housing most Americans, and they can afford it at the median income for that area. And investors and financiers love it, right? The resale and financing always exists. The cool thing is these first few things here, each of these increases the return per dollar invested over other investments, right? You buy a single family house, doesn't have that economy of scale. Here, you're netting all these reduced expenses per dollar invested. Better financing, right? Instead of this 20-year loan, you're on a 30-year loan. So your cash on cash return is higher per month because you've got less principal and interest to pay each month. You're forcing appreciation, increases the value. And then cost segregation, pay less taxes, so which you can't generally do on smaller properties. Or you can, but it's cost prohibitive. So anyway, I love this. And the scale really, really matters. But the problem is, individuals like me, I can't go out and scale on my own. Right? I'm not some super wealthy individual, but I would love to get into these bigger apartment complexes. So the way to do that is to team up, right? I bought 8 units on my own, great. I bought 16 units as a 50-50 partnership, great. But now I'm kind of like, oh, what do I do now? I team up, right? Friends, family, other people interested in investing. It makes sense to work together so that we can leverage these increased returns, right? So let's talk about the multifamily syndication. What is it? It's essentially when 2 groups of people team up to buy a bigger property, like we just mentioned. It's a perfect partnership, in my opinion. You've got general partners who are the people that go out and do all the stuff, right? They find the property, they negotiate the property, they renegotiate the property, they do the due diligence, make sure everything checks out, they verify the financials, they raise the money, they blah, 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 blah. I could go on. You can read the list yourself. There's a lot of stuff involved. So there are people that want to do that, right? And then there are people who want the opportunity to be part of a property like this and net these kinds of returns that don't want to be the general partners in doing all this stuff, all this work, right? Maybe they don't have the time. Maybe they don't have the know-how. Maybe they don't have the track record to show a financer or a broker, right? So that it'd be hard to do it alone anyway. Maybe they don't want to be involved in the daily work. So they're simply looking for a passive income check. That's why this makes sense. It's a perfect partnership. You bring the people who want to invest and net the returns, and you bring the people who want to put the deal together and manage the deal and sell the deal. That's why I love it. And so that's what we're trying to do here at Cameron Capital Partners. Our mission is to grow passive income by affordably housing Americans together. Now, the reason I chose this mission and why it's worded the way it's worded is because I believe that by focusing on providing excellent service and clean, updated, affordable housing, we can succeed. That all of these things reduce your risk, and I truly believe by providing the best service to tenants as possible, you will get the best returns. That's how life works, right? You want to be the apartment complex people want to be at. You want to answer the phone. You want to be there for people. You're housing people. These are people's lives we're talking about. This is not just a money-making business. So, in order to do the best, you have to serve people the best. Um, so that's why you're most likely receiving a monthly informational video from me, an email. In the future, I hope to start showing you investment opportunities so that we can go down this route together as a team. If you're not already on that list and you'd like to be, just shoot me a whatever, Facebook message, YouTube comment, an email, text message, phone call. I don't care. However you want to contact me, shoot it to me. We can chat. I can add you to my list, and we can go from there. But what about COVID, right? So this is topical just for when this video is being filmed. Single family housing market. As a real estate agent, what I'm seeing is that it's a mini buyer's market. Transactions are slowing down for sure across the board. However, they're still moving. Our team is still closing deals. I just closed one. This is still going. Transactions are still moving. But it's a mini buyer's market right now for the first time in a while. And I expect that to continue for a bit. That's also true with investment properties. Multifamily, I'm still receiving most of my rents. Most multifamily owners I know are still receiving most of their rents. It's May 2020 right now. We'll see how that goes over the next few months. Lenders are offering forbearance options for delaying payments if required. I've already talked to mine. I don't need it, but I just wanted to see what options were available in case we're doing this for months and months at a time and my tenants stop paying. I don't foresee this going down that route. It doesn't make sense to me on a huge, nationwide scale that tenants can't get evicted, don't pay rent, and then the owners are now responsible for somehow paying all their expenses but not making any income. That doesn't make sense because, all the tenants would be out of a home when the owner gets foreclosed on, right? So I don't think we're going to get to that point. There will be some intervention before that point if somehow we start moving towards that route. And then short-term rentals, right? They're probably getting schwacked the hardest in the short term. In the long term, I still think they're decent deals. I would never be fully invested in short-term rentals though, just because that they get hit initially in a downturn always. Of course, there's a huge decline in bookings. Rates have stayed the same in some places and declined in others, like Orlando, right? The rates have gone down and the bookings have gone down because there's nothing to do there. Can't go to Disney. But on the Panhandle, people can still go to the beach. They've just reopened. So short-term rentals are reopening. So I don't think this is going to last forever. To me, it doesn't make sense. You can social distance at home in South Carolina, or you can social distance at an Airbnb at the beach. I don't get the difference. But this isn't a political thing. Sorry. What I want to point out is that I think there will be deals to be had across the board. On the unfortunate side, for people who couldn't pay their mortgage on their homes, though I think there will be a lot of leeway for people to pick that back up later. So I don't think there's going to be a ton of foreclosures, but I think there will be owners, investment owners, who didn't have high enough margin on their property, who are self-managing and not doing a good job, and have little or no reserves that are going to need to sell their properties that you can then get a deal on. So expect that to be the case. This is just a video. Like I said, I was an idiot that didn't turn the volume on the live webinar, so I don't have any recorded questions, people asking questions and us answering them for you. I answered most of the stuff that I could think of along the way that was asked before. But anyway, that's it. I hope you enjoyed this video, and hit me up if you ever have any questions about real estate. If you're interested in short-term rentals or long-term rentals in the Florida Panhandle, hit me up. I can help you out. And if you're interested in multifamily syndication, of course, hit me up. See ya.